Welcome back, guys. Today we're going to take a look at Winnebago Industries. Now, this is a manufacturer of boats, RVs, and campers, lots of recreational products. So this company is going to do much better in good economic times and much worse in bad economic times. So it makes it quite cyclical. Over the past 5 years, they are up 73%. They also pay a little dividend. They basically kept pace with the S&P 500, so pretty good performance. Their all-time chart, as you can see, is very cyclical. It's very up and down. 2008 they dropped like a rock, and then it's just up and then down. It depends on the demand that they're having for their products. So as of now, this is kind of a smaller company. It's only worth $1.7 billion. And its price to earnings ratio right now is 18, which is not too bad. Taking a look at this part here, their revenue and margins, well, their margins were 5%, 2% during COVID, which I'm actually surprised they even had a positive margin during 2020. And then their margins have compressed back down. So they had good times here in 2022, 2021, and then they've compressed back down and even went negative last quarter. I don't really expect the negative margins to really continue, but they definitely could. Now, this company has been investing in like manufacturing plants and stuff, so their capacity is much higher. In terms of their revenue, this is a better look at the revenue. It's grown quite a bit from 2017. It's basically doubled. However, in 2023, it is in a downtrend. In terms of their income, I just showed you. Balance sheet. Their balance sheet's pretty solid. They don't really have a ton of debt. 468 million in net debt, and they've got much more assets than liabilities. They've got a pretty decent book value compared to their price at 58. Their book value is not bad. In terms of cash flow, what are they doing? Well, they pay a small dividend of 2% or whatever, and then they either issue. Well, most of the time they're buying back stock. They actually bought back 30 million in stock in Q4 of 2023 and Q1 of 2024. They bought back lots of stock. It depends what their cash flows are with how much they can buy back stock, but they also spend a lot buying new businesses and expanding their total assets, buying new plants, property, and equipment. Because if you take a look at their net property, plant, and equipment on an annual basis, you can see it's been growing from 72 million all the way up to 378 million. So they're definitely investing in new manufacturing plants. In terms of stats, let's look at their return on invested capital is pretty solid, usually around 12%. It looks like gross margin about 15 to 16%, and then net margin it ranges from like 4% to like 8% usually, except for last quarter was negative. Here is their Q2 earnings slides, and they're saying that they had a pretty decent performance, even though they had negative net income. But it's from continued market softness. So the consumer is pretty weak, you can tell from this. And the amount of orders has been declining for the entire RV industry. And then luckily, this company's market share has been increasing. So pretty decent. Although I'm not quite sure about this. It's 12.2% and then goes down to 11.4, but the arrow's still going up. So a lot of times they paint these pretty pictures. So maybe they're losing market share in the last couple years in their RV market share. For their boats, their pontoon market share has been increasing. What else can we look at here? They're saying that the backlog has been decreasing because of cautious dealer network in their towable RVs. Their motorhome RVs are down, and their marine segment RVs are down, or marine segment is down quite a bit. So not looking too good for the immediate future of this company, just because it seems like the consumer is quite weak at the moment. taking a look at well, actually, this is all the brands they own. They own a bunch of brands. This is for boats. They also own Winnebago. Let me see. Yeah, Winnebago, Grand Design, Newmar, and then they own some boat brands as well. But here's what the analysts are thinking. The analysts are thinking $5 a share going up to $7 a share in 2025. So the analysts are thinking that they're going to get back to their normal profitability after this year passes. So this year their margins are going to be compressed, but they're thinking next year they're going to expand their margins back up. And yeah, their revenue minus 10% this year, but they're thinking they're going to be able to expand their revenue back up by 13% and get back to $3.5 billion in revenue. In terms of their stats, so this is another good thing to look at. Look at their short percentage, and their short percentage is 24%. That is extremely high short percentage, and that is a massive red flag. Any company with a short percentage above 5 is a red flag, and this one's at 24%. So just based on that, I would definitely not touch this company at the moment. However, if they dip quite a bit, then maybe it would be a good point to open a position. But yeah, definitely just based off this, I wouldn't. However, let's look at the DCF model that I have. And based on this model, they do look undervalued. However, I am putting in some pretty good assumptions for the company. I put their earnings estimate here, revenue estimate here, buybacks 0. They don't really do much in buybacks. I mean, sometimes they do, sometimes they don't. Net debt of $468 million and discount rate of 10%. Exit multiple of 15. I think that's fair for this business because it is quite competitive and yeah, it's manufacturing. So 15 I think is fair. Discount rate 10% because I want 10% return. I don't know if I just said that. Okay. Now for the earnings model. The estimate is for them to go back up by 7%, or I mean to $7 a share, which is like a 15% increase. So that's what I put here. And then I just have them increasing by 5% after that. It's definitely possible that some of these are negative. I think on average 5% is an okay estimate. In this case, they're worth about 75 probably, somewhere in between here, about 80 probably. And with the revenue margins model, their profit margin has been ranging between 4 and 8%. This year, they're projecting about 4 to 5% in their profit margin. However, last quarter, it was negative. So I could see this profit margin being closer to 0, maybe like 1 or 2%. And then their profit margin expanding back up to 5%, more of a historical average for them. And then their revenue growth, the analysts are projecting 13% into 2025. Then after that, I have them growing by 5%. Definitely possible that some of this is negative as well. Depends on how strong the consumer is. We could put in some more scary assumptions. Let's put in some worse assumptions here. Let's have a profit margin of 1% here, and let's say that their profitability is quite low for the next 2 years, and then their growth is actually negative instead of positive. Let's say the growth is another negative 10%, and then they grow back out of that by 5%. Yeah, we'll say that this would be a more like pessimistic scenario. In this case, they are worth about $60 a share, so about where they're at. I'm not quite sure why it's so heavily shorted. It seems like this company has been performing quite well. They do have pretty solid earnings. However, yeah, they're thinking short term, this company could be taking a hit. So personally, I would not open a position in this unless it drops quite a bit and we see that short percentage be covered quite a bit. Like it's probably a solid company. They've been growing. They've been investing in new manufacturing plants. So of course there must be demand there. But let me know what you guys think. If you want to, you can use this spreadsheet for free. Just check a link in the description. And yeah, I'll see you in the next one. Peace.